Okay, folks, well, happy Monday. Well, for some people, but not for everybody, because we're seeing the stock market. Well, the stock market, right when I was prepping for this video, the stock market was down 300 and now came all the way back and it was flat the last time I checked. But what you want to see on your screen is look at over my right shoulder here. The markets are crashing. These are the bond yields on things. So we're going to get to that here briefly. But this is what I go over on a daily basis to keep you guys on, what's going on in the stock market, what's going on in the bond markets, what's going on with mortgage rates, what's going on with housing. That's what we talk about on a daily basis. So in today's headline, banks are going crazy. One bank got SVB Bank closed down on Friday. Now more banks are following suit. Is this going to be a pandemic running rampant through all of banking? No. Let me explain to you what's going on, okay? So basically part of the Dodd-Frank bill that was created years ago was to have banks more solvent. So what was required was they have to hold a certain percentage of what they lend out in assets, okay? An asset. Well, a lot of these companies went out and bought the treasuries because treasuries are usually one of the stablest investments out there. So they would load up on treasury bonds, okay? So that's what they did. They've held a bunch of treasury bonds. One caveat behind this is when they purchase that asset, that's how much that asset is worth. So think of it in your situation. You buy a stock, and I don't know about you, but even if you bought Google stock last year, it's probably down 20 or 25% or maybe even 30%. So if you look at it and you see the price you paid for it, you'd be like, oh, okay, that ain't bad. But then if you saw today's price, you'd be like, oh boy, I lost money. Well, banks right now don't have to what we call mark to market. Okay, so here's what I mean by that. They hold bonds and the value of that bond is the price that they paid for it, okay? Not the current price. So keep that in mind, okay? And part of this piece was created by, it was part of the Dodd-Frank bill. Barney Frank was a part of that legislation. I want you to keep that in mind as well, okay? So here's what's been happening. You see right through here, the Federal Reserve has been raising rates. And so what are they doing? They're driving down bond prices. Remember, there's an inverse relationship. If the price of bond goes down, rates go up. Price of the bond goes up, rates come down, okay? So the Federal Reserve has been adamantly pushing up rates. Thus, what's happening is it's pushing down the price of these bonds, okay? So remember that. When I said a company or a bank had to hold an asset for solvency, they don't have to market to market, okay? They don't have to mark the price to market price, okay? So now these assets are worth way less today than when they bought it. Okay, as you can see on the chart to my right, right over here, right? So if you bought an asset up here at that price, now it comes all the way down to here, you don't have to readjust your balance sheet for that. Well, you should, okay? I have to do it in my assets to figure out what my net worth is, so shouldn't banks have to do the same? So what's happening is the Federal Reserve is raising rates at an unprecedented level that we've never seen in decades and decades and decades, thus pushing down the price of these bonds. So now all these banks that are holding these bonds, those bonds are probably worth 20, 30, 40% less than where they bought them. Okay, so now that banks, or a lot of banks probably at this point, need more reserves. So what happened with this bank, Silicon Valley Bank, is what happened is we had a couple huge investors basically tweet out and say, I'm going to take my money out of there because it's not looking good for SVB Bank. So some big investors started pulling out their money because they tweeted it and put it all over social media. Now the average person's going to run on the bank, and that's what you call a run on the bank. You run to the bank as fast as you can, pull out all your money, and move it to another bank that's more solvent. Well, if you have everybody do that, basically they're going to pull out all their money. The bank won't have any money left, okay? That's basically what happened in this case. So the FDIC steps in. They insure depositors up to $250,000. Most banks have about 80% of their deposits are insured, okay? SVB Bank had 40%. So less than half of what is the norm, okay? I want you to remember that as well, because I'm going to tie a lot of this stuff together. That's going to probably tick off a lot of people, but a lot of you guys out there are going to say, maybe we are being manipulated, okay? Well, let's get over to it. So the first thing you're going to see right here, here's what's going on in the stock market. Let's go down and see if it's up or down or up or down. Now we are up 62, all right? So that's what's going on in the broader markets. But we go down through here, and now we have yet another bank, First Republic Bank, Their shares are down 60% because of the the effect of the Silicon Valley Bank throughout the rest of the industry. It's like you kind of throwing a pebble into a lake. It blips, you have that first splash, and then you start having the ripple effects. Okay, so you can see here Dow falls more than 150 points on Monday. It's only down 6 now or whatever, but it was down almost 300 just a little bit ago. Investors rush into bonds, gold, and flight to safety. Now, this is another thing you're going to hear. Flight to safety. What does that mean? Well, basically, it means this. You think the stock market's going to crash. You think a lot of things are going to crash. You just want your money somewhere to earn some kind of yields to protect yourself. So a lot of people are running into bonds, kind of like the banks did back when, and they continue to do because it's usually a safe bet, and gold. You're also probably going to see that Bitcoin and a lot of cryptocurrencies are going to kind of rise on this because weren't we sold a bag of goods on this saying it's a great hedge against inflation? Well, inflation's out of control, and Bitcoin went from 60,000 a coin to 20,000 a coin. So not a really good hedge of an inflation in there. But let's see. U.S. government steps in and says depositors with funds at SVB Bank will be able to access their money, and that would be today. You can do that. And I posted a video on Friday right before I left. I also gave you an 800 number you can call if you have money in that bank. Let's see if there's any other news through here. Nothing there. Okay, so let's go to the next caption. Silicon Valley Bank attracts companies like tech startups while Signature Bank became popular with the crypto industry. So now we have Signature Bank basically just got shut down as well. They got shut down, I think it was over the weekend or on Friday as well, but you didn't really hear much about that. Why? They're heavily invested in crypto, in the crypto business, okay? Where Silicon Valley Bank was startups and venture capital companies. So these are really speculative banks, that people in those bubbles put their money in. They're either high wealth, high leveraged, or so forth. So it's a risky business when you're dependent on cryptocurrencies, venture capital, and startup businesses. All right, but the interesting thing is, part of here, let me go. This is also just got posted just to validate that. So on March 12th, the joint venture from the Treasury and Federal Reserve, FDIC, came back and said that they're, what they're going to do with Signature SVB Bank. But we are also announcing a similar systematic risk exception for Signature Bank, New York, which was closed today by its state chartering authorities. Okay, so we got Signature Bank is closed now, SVB Bank is closed now, and then you also have right through here, you have First Republic Bank getting crushed. All right. The interesting thing here is who sits on the board of Signature Bank? Well, none only then Barney Frank. Now, remember Barney Frank at my beginning of my conversation was part of he created was part of the creators of the Dodd-Frank bill that put in tons of banking regulations. Isn't it odd, or I guess hypocritical, that Barney Frank now sits on a board that just got, they've been shut down for insolvency? So you're at the government, you make these banking rules, and then banks hire you, and then that bank goes out of business. Not a very good track record there. Okay, so let's go through the next piece of this. Now it's my hypocritical piece of the video. Now you also have President Biden says those who invested in failed Silicon Valley Bank and Signature Bank will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. Okay, well, let's look at it this way. If you took a risk and signed on a student loan debt, then you went to school and got a college, education, or at least you went as long as your money held out, then you got out of there. Now you're saying you can't find a job, so now you don't want to pay for that college. Isn't that kind of like this? So I'm not trying to step on the toes of people out there that have college tuition and want it forgiven, but I put 3 kids through college and paid the full bill. So that was part of what I signed up for. And it's not, I don't think of that as capitalism or not. It's an agreement that I made. Okay, so when a company fails, if the administration likes them, they'll fund it. If the administration doesn't like them, they won't fund it. Kind of hypocritical, if you think. The next piece of this is Jim Cramer. Now you have people all over Wall Street. You have our politicians. I just showed you, Barney Frank sits on a board of a bank that just is failing. President Biden's coming out saying, well, we shouldn't, if, in a capitalist company or society, if you invest and it doesn't work out and you lose, you lose. Okay, so I can give you 1,000 examples on how that never plays out. Now we have Jim Cramer, the spokesperson at CNBC, their golden child, the guy that they give $50 million a year to or whatever the heck he makes by doing what he does. He's entertaining, I give him that, but he's not very good at his picks. I followed him for years and lost my ass. Now look at this. Jim Cramer recommended what? What's behind my head? SVB Bank. When? Less than 30 days ago? Okay. If that doesn't do it for you, how about Bear Stearns? You remember Bear Stearns? They're no longer around. They went insolvent back in 2010, 2011 or so forth. The day before they basically became insolvent, what did we have happen? Well, Jim Cramer came out and says, you'll be fine. Don't take your money out of that investment. Wonder how much money he had in that investment, or was it giving him time to take that money out? I don't know. I don't care, but that's my hypocritical thoughts of the day. So the reason why you're here, and we're going to do this on a daily basis, is where the heck are mortgage rates? So mortgage rates aren't posted yet, but I want to show you this. This is a live feed of what's going on, but to make it a little bit easier for you guys to read, here's where we are. So we have the MBS market right now up 92. Well, I've only seen up or down 92 or 100 probably about 5 or 6 or 8 times in my whole career over 34 years. So this is a big move. So again, remember, there's an inverse relationship. If the bond price goes up, yields are going to come down. Okay, so based on today's information, rates are going to start coming down. All right, where are we? Well, based on Friday's close, here's where we are. The banks aren't open yet, but these are the top 6 products that people choose when they're buying or refinancing a home, and these are rates published by Mortgage News Daily on a daily basis. These aren't my rates. These are no individual bank's rates. These are a blend or national average throughout the whole country. You can see the 30-year fixed right now is 6.76. It is down a quarter from where we were on Thursday, and we're probably going to see another quarter point or more today once once banks start opening up. So that is my report for today, guys. So be calm. This is all going to settle out. You're going to see hysteria in the markets. You're going to see hysteria all over the news and YouTubers just getting you to click, and then they're going to explain, this can be catastrophic for all the banking systems. The Federal Reserve is not going to let that happen, nor the government's not going to let that happen. So relax. This is all going to pop back to as normal as it can be. But I'm predicting this will not be catastrophic for the banking system. This will give you a little unique time to maybe put a little bit more money in the market to work for you, or maybe check and see if you closed on a mortgage. Probably in October, November, December, even January, you might want to look at refinancing because rates might be about a point less than where you closed. If you need help with that, please reach out to us. We would love to help. So other than that, guys, that's our report for today. I appreciate you guys watching. If you find entertainment value in this as well as educational value, please, all I ask you, give me a thumbs up, subscribe down below, hit the bell every time I post a video, you get an alert. Take care, guys, and I'll see you tomorrow. Bye-bye.